So you've been seeing people talking about futures trading and making money from doing this and trading this and trading that, and you're unsure on what they're even talking about, but you're interested. Well, I'm here to break it down for you, okay? Oh yeah, and real quick, if me not having a pinky nail on, if me not having a pinky nail on bothering you, I suggest you leave the video, okay? Thank you. So, what is futures trading? Okay. Futures trading involves buying and selling contracts tied to an asset, okay, to make a profit. Unlike investing, which is a long term type of growth, futures is more on a short term growth. For example, imagine you love ice cream, okay, and right now a scoop of ice cream costs $5, okay, but you're worried that the price might go up next week. So you make a deal with the ice cream shop, like, all right, next week I'm gonna buy a scoop for $5, no matter what the price is. Then, if the price goes up to $7, you got a great deal, okay. But if the price dropped down to $3, you still have to pay that $5, even though it's cheaper now because that's what you agreed to. Hence, it being a contract. So now, who trades these markets are, your hedge fund investors, your investment funds, your corporations and producers, companies that produce or use commodities, like oil companies, farmers, airlines, manufacturers, and then you have us, the small, impactful fries called retail traders. Okay. I say impactful because some of us are eating good off this. All right. Now, the type of things that move the market, your volatility and things like that, are your geopolitical events, your elections or economic data, things that's going on in the world, like inflation, you know. But overall, we can just call it buyers. We just call it buyers and sellers, okay, which are your bulls and your bears, okay, bulls going up, bears going down, okay. So you're buying and selling assets, and some of these assets, for example, are SPX 500, gold, NAS, oil, and plenty more. And these are what you're buying your contracts on, okay. Now these contracts do expire, so keep that in mind. But you can go on things like CME Group, that'll give you all the information such as the current contract, the volume, the tick price, the tick value, and just about anything else you need to know about an asset. Okay. Now, speaking of tick value, and if you came from Forex like I did, you could look at futures like this. Your contracts are your lot sizes, and your ticks, some may say points, are just pips, and since I'm on a topic of futures and Forex, let me explain to you the difference. Okay, so I got the board out because maybe you're a visual learner like I am, and we have to see things for us to better understand it. Okay, but I want to get into the difference between forex and futures. And forex is just your nickname for the foreign exchange market. Okay, and within this market, you're trading currencies, and with futures, you're trading contracts. And within Forex, not only that you're trading currencies, but you're trading currencies in a decentralized market, meaning there's no central exchange. So, hold on. There's no central exchange, okay? And it operates through banks and brokers versus futures, which is a centralized. Hold on, gotta write this down. Centralized, it's heavily regulated, and it's transparent. And that just means that everyone sees the same price because the trades go through one single system. Okay. For example, okay, you go to Walmart and everything is in one place. You know what you're getting, there's no negotiating. Okay. And what I mean by no negotiating is, you can't go and see this 7,500 inch TV. Now, I meant 75 inch, but you got to forgive me because I speak in the hundreds and the hundred thousands. All right. But, anyways, let's get back to it. Or 1K or $1,000, and you go up to somebody and say, "Hey, I only have $800." You gonna take it or leave it? No, Walmart's price is Walmart's price. Okay, honestly, I don't think there's even no one in Walmart that you can talk to and negotiate a price with, unless you're talking to the CEO or something, versus going to a flea market where you have different buyers and, your price is going to vary. And you can go up to a booth and be like, "Hey, here's $10 and something may cost $20. And if they want to take it, they take it. If not, they'll tell you a price. That's what I mean by your centralized versus your decentralized market, your one system. Okay, futures operate through your one system, your Walmart way of doing things, versus Forex is your flea market way of doing things. Now the transparent part of futures means there's no broker manipulation or hidden spreads. So hold on. No broker manipulation, because you know what I'm talking about. Hidden spreads. Okay, versus Forex, because of your banks and your brokers, you have different kind of brokers, different kind of banks, and they have different requirements, they different ways of doing a system. Your spreads will vary. So I'm just going to say, that's why you may go to a broker and you have high spreads, or a lot of times you see banks or brokers promote low spread costs or things like that, because of that reason. And a spread is just basically a fee that you pay to place a trade. Okay, so you will need the price to move in your favor past the spread before you start making your money. Okay, so if the spread cost is two pips, ticks, whatever the case may be, then you need to go past that two in your direction that you want it to before you can start making money. Futures still has spreads, but these are tighter spreads. Why? Because of your centralized market, your one system. We all have the same thing. We all got the same type of spread. So we're all getting in at the same time, in a way. So yeah. Okay, so I want to give you a little two for one, okay? And you'll see what I mean in just a second. But I want to get into the value of ticks, okay? Keep in mind that each asset has its own tick value, all right? So depending on what you trade, it will be a little different, okay? But since I mainly trade gold, I'm going to use gold as an example, okay? So each tick for gold, which is GC, let me write this down. And now each tick, which represents price movement, is 0.10. We're going to say 0.10 cents. So price movement equal. Now each tick is worth $10. So the value $10. Okay. So if price is at 2180.0 and it moves to 2181.0, that's 10 ticks. Now stay with me, okay? Because I am breaking it down. I am breaking it down. So we got, hold on, let me erase this. We know that we're doing gold, okay? So You have 2180.02, 2181.0 equal 10 ticks. Now I'm about to explain why or how we got 10 ticks. Okay, so this is how the market moves. All right, so we have 2180.0. Then we have 2180.10 because 10 cents, we're just, we're looking at it at the cents. 2180.20, 30, 40. It might get smaller and smaller because I gotta put it all on the board. And then you got 0.0. So that's basically me giving you 10 cents until you get to $1. Okay. But within that dollar, those cents right here, these right here are your ticks. Okay. Your ticks. These are all your ticks because it's 0.10 cents. All right. And the value of these ticks right here are $10. Okay. So you got 10, 20, 30, 40. So every time it moves per increment of these right here, you're getting, that's $10. So that's how we got 10 ticks going from 2180.0 to 2181.0 all in one move. That's what's going on. Okay, so since we know that 2180.0 to 2181.0 is 10 ticks, how much is that per contract? So hold on. So you got 2180.0 to 2181.0. That's 10 ticks. Okay, so we got 10 ticks, right? The value of that is $10. So all you're doing is timesing that by 10. That equals just $100 per one contract. And for my Forex contract, this one lot would be $100. So yeah, now that we understand how the ticks work and the value, let me give you an example. And this is what I mean by your 2-for-1. I want to know if you have proper risk management or not. Okay, so let's do this right here. Let's say you have $1,000 in your account. So we got $1,000 in our account. Okay, we starting off good, and we want to get into a trade. We got in, and our entry is entry 2180 because we're going to just stick with the 2180. Okay, and your stop loss is going to be 2178. This is 20 ticks lower. And then your TP is going to be 2182. Higher. Okay. So you may look at this right here and say, oh, this only moved up to or down to. But we have to remember that within that two, that $1, what's going on in that $1? Each cent within that $1 is 10. So, and we have two. So this is 10 for one, 10 for another. That's how we got 20. So you got 20 ticks lower for your stop loss and 20 ticks higher for your take profit. And we know that each tick is $10, right? So all you're doing is you got 20. So 20 ticks, okay, at the price of $10 times it by 10 gives you $200. Just $200. Now, within that $1,000, is it okay to risk $200 in $1,000? I'll give you a second. Yes, yes, it is. That is great risk management there. Okay, you're risking $200 within this $1,000 account. Okay, so let's say you have this right here. Let's say you have a 50 tick stop loss. 50 ticks, right? If you're risking 50 ticks, and per tick, how much are are you risking? How do we calculate how much we're risking by the ticks? Well, the tick value is $10. So 50 times 10 is 500. 500 is that okay to risk 500 and you have $1,000? You have an $1,000 account? No. Okay, that's half of your account. Imagine you got in for two contracts, because this is just one contract. Maybe you were feeling confident or something. You got in twice. What happens? You got in for two contracts. Two times this by two, that's $1,000. That means your $1,000 is gone. That's improper risk management. Okay. So yeah. Now, with all of that being said, hopefully you were able to understand most of this, because I know when I first started, I didn't know what any of this meant, but learning this helped me understand like what role I played in the market, and also how I can benefit from it. But if there's any areas you maybe need help with, drop it down in the comments and I'll either show or help break it down, for you. But other than that, stay tuned for the next video, because I'm just a girl that trades, okay? So I'm out.